In a quiet corner of the financial world, a 35-year-old investment titan called the Carlyle Group is conducting one of the biggest experiments in corporate history. With over $350 billion under management, they're investing not just in companies anymore, but in intelligence itself, artificial intelligence. While headlines focused on ChatGPT, Carlyle was teaching machines how to read earnings reports, predict market sentiment, and even help hire CEOs. The world of private equity thrives on one thing: information. The sooner you get it, the quicker you win. Carlyle knew this early. As competitors fought for human talent, they began recruiting machines. They invested billions in tech. They didn't just dabble in AI, they went all in. One of their first big moves, acquiring a majority stake in HireVue, a company that uses AI to screen and interview job candidates. Imagine being interviewed, not by a person, but by an algorithm analyzing your tone, your pauses, even your eye movements. For Carlyle, it's not about replacing humans. It's about finding better ones. The investment stemmed from Carlyle's $18.5 billion private equity fund, part of a grander strategy to funnel nearly $30 billion into tech innovation. Their message was loud and clear. AI isn't the future, it's the strategy. In finance, information is gold, but sifting through millions of data points, from earnings calls to breaking news, takes precious time. AI changes that. Carlyle's partnership with SESAMm, a natural language processing firm, empowers it to scan thousands of news articles, tweets, and financial documents. The system doesn't just count words. It measures emotion, sentiment, and momentum. An AI can gauge if investors are anxious about Tesla before the stock moves. It senses optimism in emerging markets before anyone else does. For Carlyle, it's like having a radar that sees through the fog. In the world of private equity, speed is everything. Finding, evaluating, and managing investments used to take weeks. Now, thanks to AI, it takes hours. Carlyle employs AI for due diligence, to scrutinize companies before acquiring them. Algorithms can now analyze thousands of financial statements, media reports, and alternative data sources in mere minutes. What once required a team of analysts a full day, AI now accomplishes in an hour. Once an investment is secured, AI continues its work. It monitors portfolio companies, identifies inefficiencies, and even suggests when to sell. Carlyle has reported AI optimizing supply chains, automating shipping, and predicting product demand in the automotive sector. But here's the question no one's asking. Would you trust an algorithm to choose your career, your mortgage, your pension? Carlyle isn't alone. Across Wall Street, firms are racing to weaponize AI. Vista Equity Partners has fully committed to generative AI, transforming its software portfolio with automated tools that cut costs and heighten profits. They're employing AI not only to analyze markets, but to redefine them. Blackstone brought in new leadership from General Atlantic to helm its AI-driven platform. Additionally, firms like Mercado Partners and Arrowroot Capital are backing startups developing the AI infrastructure of tomorrow. In this new game of financial chess, the players aren't human anymore. They're neural networks. The AI market is booming. Analysts predict it will reach $1.6 trillion by 2030. Venture capital is flooding in. AI startups now capture nearly a quarter of all VC funding worldwide. When ChatGPT amassed 100 million users in just 2 months, faster than any app in history, investor excitement soared. Mentions of AI on earnings calls exploded. NVIDIA, Alphabet, and Microsoft have become the new titans of the digital age. For private equity, AI is now as fundamental as legal or financial due diligence. Firms are developing scorecards, automated underwriting systems, and predictive dashboards. AI has transcended from being the assistant. It's the analyst, the strategist, and sometimes the boss. The potential impact? Tremendous. Generative AI can cut software development time in half, shrink drug design from months to weeks, and lower costs in life sciences by 15%. Economists expect productivity shocks as high as 215% by 2041, rivaling the Industrial Revolution. During the 1920s, electrification doubled manufacturers' returns. AI could triple them. For Carlyle, this translates to better investments, faster profits, and smarter decisions. Every second saved, every bias eliminated, that's real money. AI might automate 60% to 70% of jobs. It's already acing the bar exam, achieving a 3.4 GPA at Harvard, and coding better than junior engineers. And then we have hallucination, when AI confidently outputs false information. In investing, one incorrect prediction could cost billions. The risks go beyond technical, they're ethical. I trained on biased data can discriminate in hiring, lending, or admissions. These aren't just hypothetical, they're happening now. Governments are scrambling to keep pace. The EU AI Act, set for 2024, categorizes AI systems as high risk, low risk, or outright banned. In the US, the SEC, Treasury, and Federal Reserve are evaluating AI's role in financial compliance and bias. For global giants like Carlyle, it's a balancing act. Innovate too slowly, and you fall behind. Move too fast, and you risk billion-dollar fines. In this landscape, intelligence isn't the only currency. Trust is. In the end, AI isn't replacing investors. It's becoming one. The Carlyle Group is not just betting on algorithms. It's banking on a future where machines and humans collaborate. The question isn't whether AI will dominate Wall Street. It's whether humans will continue to grasp how it works. AI is already investing in us. The pressing question is, are we prepared to invest in it?